The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Welcome back to Options Insider Radio, the program where we take guests from throughout the options industry and pick their brains about the latest developments from the world of options. And today's guest is Ed Provost. He is the Executive Vice President and Chief Business Development Officer over there at the CBOE. Ed, welcome to the show.
Good morning, and it's great to be here.
It's hard to believe this is your first appearance on the program. I think we've had everyone else at the CBO but you on the shows. I think you've been avoiding us.
Well, I don't know if that's been the case, but I'm looking forward to our discussion.
Speaking of discussions, maybe we'll get right into it. Of course, we are recording this here at the 2012 Options Industry Conference in New Orleans. And there was some interesting discussions to be had yesterday on the Exchange Leaders panel. And Ed, you were on that panel along with Gary Katz, the CEO of the ISE, who will be coming up on this show later. And from what I hear, I wasn't there, I was recording in this room. From what I hear, things got a little, shall we say, heated, specifically around the subject of ISE's max SPY contract. And for listeners who are not familiar with that, that is essentially a new offering or potential offering from the ISE that takes the SPY contract and multiplies it by 10, so and effectively replicates the SPX contract. And so obviously yet another inroad or attempted inroad by the ISE in this product category. They've tilted at the SPX windmill in the past with, shall we say, less than spectacular success. They're going after this again. Tell me a little bit about what the gist of the conversation between the two of you was yesterday, and then maybe we can follow up with why you think ISE is so determined to get into that SPX product in any way, shape, or form.
Sure, no problem. Well, new product discussion is always a significant part of those panels, and indeed the moderator did tee up the issue of the ISE's proposed new product, which, as your comments indicated, is very much a knockoff of the SPX contract. And I think every exchange, being as competitive as they are, would like to break into space that another exchange has been successful in. And in that particular product, of course, the SPX contract has been a very big success at CBOE. It's a product that exists at CBOE pursuant to an exclusive license between CBOE and Standard & Poor's. And because of that, and because of the fact that it involves the property rights of S&P and the licensing rights of CBOE, there's great sensitivity to any product that might attempt to replicate that and violate the property rights in particular of S&P. So we believe that product does, and our debate centered around that particular issue, and it was great fun. But at the end of the day, I think the courts, unfortunately, will be making a final decision on that product.
That's unfortunately probably true. Now, Ed, maybe you can explain this to me. I'm curious. What do you think? Because, like I said, Gary has tilted at this windmill in the past and lost. Of course, they sued to try to multiply list SPX several years ago. That ended up being a failed endeavor. I believe it might still be lingering in a third appeal or something like that. But essentially, they missed on that one, and yet they're doing this again. You think Gary just enjoys paying his lawyers, or why does he keep tilting at this one particular windmill over and over?
That's a tough one for me to answer, and I think
put yourself in Gary's shoes.
Listen, if I'm in any exchange's shoes and there's a product out there that's very successful, I'm going to try to figure out every way that I can either trade it or trade something that is as close to it as possible. Because, again, we're all businesses. We want to provide trading opportunities for the members on our exchange and for the company itself. And so, again, I think that's something that is to be expected to some degree. But then again, when you talk about utilizing someone else's property, it often comes down to a debate over the details of the product. And in this particular case, we believe, and it'll be ultimately the decision of the court again, that this is a product that represents the property of another organization, S&P, and ultimately you'll need a license to be able to trade a product like that. And up till now, anyway, S&P has decided to license out the rights to trade options on that product on an exclusive basis. And if they choose to change their mind on that in the future, we'll see what happens.
Let's stay in the exchange realm for a moment then, because I was also chatting this morning with Tony McCormick, the CEO of the Box, and we were discussing they're very excited to finally have their SRO status under their belt, and it kind of got to a discussion with us, and I would like to extend this to you as well about, in this post MF global world now, being an SRO is a bit of a double-edged sword. There is a lot more scrutiny on those firms doing that. There are a lot of critics out there, including many vociferous ones in Congress, who think exchanges shouldn't be SROs. I think it's kind of like letting the fox guard the hen house. And so I'm curious what you think about now and what you think about that in this day and age now. Is it almost, obviously CBOE has been entangled in this as well recently. Is it almost not worth the hassle at this point to be an SRO and all the impending litigation and oversight and things that come inherent with that?
Well, listen, I've been in the business over 35 years, and the first 10 years of my career was in the regulatory division of CBOE. So I have a strong basis for understanding the self-regulatory process and the people that work both at the federal level and at the exchange level in terms of regulating our marketplace. I think the self-regulatory process does basically work. It allows there to be a very option and product-specific expertise that's applicable to the regulatory process. And as much as we have great respect for the government and its oversight responsibility, I think the ability to regulate the marketplace does require the level of expertise that exists at the SRO level with the proper oversight of the federal government. And there's no question the SEC, with a lot of pressures that are upon them, is more vigilant than ever in ensuring that all of the exchanges do the job that is expected of them. So it's a somewhat thankless job. You can do 1,000 things right and make a bad judgment on one issue and find yourself criticized, but that goes with the turf. We believe in the self-regulatory process and have every reason that it'll continue into the future, but we greater scrutiny every year that goes by.
It's true. A lot of these critics, I think, assume a certain level of sophistication on a part of the governmental regulators, the SEC and whatnot, that may not be there to the extent that this industry really needs, which is probably why these SROs still need to exist. There is, like you said, a certain product-specific knowledge that comes with being in this space that the SEC, because their mandate is much more broad. They're primarily an equity regulator. Options is a subdivision for them. It's difficult to expect them to bring that same level of expertise to the table.
Yeah, I think that's probably true in everything that they regulate, and certainly in our business. There are oftentimes in our regulatory area people like yourself who are former floor traders who have really understood and traded their product, had their money at risk, and have changed their careers and worked, now in this case, work in the regulatory area, and that brings tremendous benefit to the SRO in terms of having people who have really used the product, helping regulate the product.
Yes, that is the best way to understand the risks if you've actually been there with risk on the line. Let's dive back into the products again for a second too, because there is so much to talk about on that front at CBOE. That's why I like bringing CBO on the show, because I get to talk about products. It's disheartening to me whenever I sit in here and people come in filed across from me at those seats, and I hear yet again about X market model that's going to carve out X percent of an existing subset of the options market. And there's not much talk about bringing new things to the table, bringing new entrants to the table, bringing new products to the table. So I like having a chance to chat with you guys at the CBO, because you do a lot of that. And speaking of new products to the table, you launched a new product with relatively substantial fanfare, of course, the SPX PM. I think a lot of people, myself included, expected perhaps a more rapid uptake of that product, particularly on the institutional side. They've certainly been trading it, but I think you would agree, nowhere near the size a lot of people expected, given the interest and the buzz and the talk that's been going on about a potential electronic SPX product for so long. Since I was out standing in that pit 10 plus years ago, it's been a buzzword. So, A, have you been a little surprised that the institutional crowd hasn't migrated more liquidity into the electronic? And B, why do you think that is? Why do you think they're still primarily executing in the floor and maybe doing a little bit of layoff in the electronic product?
Yeah, so possibly one of the first misperceptions related to SPX PM is that it was an attempt to make the SPX electronic. And in fact, we created the product to really be as a substitute for spider options. It's 10 times the notional size of the spider option. It settles PM and it's fully electronic. And our real target market for that group is the spider user, not the SPX user. The SPX product is heavily institutionally traded, yes, with substantial spreading. So about 80 to 90% of the contracts that trade in that product are complex spreads. in sometimes tens of thousands of contracts. We think the open outcry marketplace provides the liquidity for that kind of size, and we believe the SPX will continue in its market model and catering to that particular type of order for some time into the future. Our real focus is the Spider product, the most liquid product in the industry and the most actively traded. As you can recall, when you were on the floor trading, people and traders in particular are not apt to make switches without some good thought. So it's a long process in trying to get people to change habits. We've been not terribly disappointed with our success. So in March and April, we had open interest at expiration of 100,000 contracts, in fact, in excess of 100,000 contracts. And notionally, that would be like 1 million contracts of Spider. So
I think people sometimes forget the notional value of those contracts.
Yeah,
it's substantial.
And we're quick to point that out. So while, yes, we might have hoped for slightly larger volume levels at this point, we're facing a very slow market, as you know, generally. Developing new products is a long slug. The SPX product itself took several years to take off when we introduced that back in the 80s. So we're hopeful that the product will be very successful in the long term and not terribly disappointed with the volume levels at this point.
It is very much, like you say, a bit of a new focus for the SPX. I mean, that has, as you said, been traditionally the 8-leg iron condor swap, risk reversal swap, quoted 10,000 up type of product for a long time. Yet going after that SPY audience is very much a high-end active retail audience. So it is a little bit of a perception, I think, shift and a targeting shift, I think, for the SPX. So what do you think about how do you go about making that shift, and what are you planning to do to try to lure, like you said, those essentially high-end active retail from SPY into the 10X SPY contract, essentially the SPX?
So we've used a number of ways to try to reach out to that audience. We've provided webinars and educational information on our fabulous website, CBOE.com. We've gone out to the brokerage firms who support the more active and sophisticated retail community, which has been an early adopter of the SPX PM. We've also spent a fair amount of time in the hedge fund community because we think that among the institutional users is a more likely area to make the move from the Spiders to the SPX PM. So we have boots on the ground. We have advertising. People have often mentioned to me the advertising they've seen at Grand Central Station in New York and the station in
the
Chicago.
Cub seats and the Blackhawks.
Yeah, right. So you try to reach out as effectively as you can and try to expose the market to the fact that it exists and what the major attributes to it are. So we think we've made good progress and there's a lot of work to do.
Now, you recently announced during your earnings call a pending upgrade to your C-Flex seat. I believe you call it, or suite. I believe you call it CBOE Command. It's a very interesting name. Tell our listeners a little bit about that and what upgrades they could expect when you roll it out, I believe, in late Q3 or Q4.
Great. Yeah, sure. So historically, our trade engine has been called CBOE Direct. We built that in the late 90s, and we have made substantial modifications to that over time. There is a significant enhancement to our trade engine, which warrants the rebranding of that product to CBOE Command. The main one, which you pointed out, is our C-Flex 2.0 functionality enhancement. And what that is electronic support of the Flex Option product. Flex Options being the product that allows an investor to fine-tune the terms of an option contract, setting the expiration date to something non-standard, the strike price, or the settlement features, or other attributes of the contract. And that's a part of our overall effort to lure more of the over-the-counter option trading to the listed environment. Prior to CBOE Command and C-Flex 2.0, that had to be traded on a separate trade engine that was built for us by a third party, something we typically don't do.
C-Flex was an external type of
That's
product.
correct. And now we've incorporated that into our main trade engine, and we've done other software enhancements to further reduce latency. And, of course, we are going to be relocating our main trade engine to Secaucus, New York, actually New Jersey.
Along with everyone else, it seems like.
Yeah, that's right, eliminating that geographical latency between the East Coast and the Midwest. So all of that collectively puts us in a much better position than we had been. And again, we are very unique in offering the ability to flex transactions electronically. So we're very excited about the whole project.
It's been a long-standing initiative for CBOE, the Flex, and that goes back well over a decade, the ability to offer those types of flex options to attract that OTC audience who likes non-standard options with their own expiration dates and strikes and what have you. So I'm just curious how obviously you're upgrading it, so that will bring in more volume going forward. But how has that initiative gone? I know since you upgraded to CFlex and made a big push in that market a few years ago, how has that? Have you the narrative and options for the last few years is, given the regulatory heat, OTC is coming to the exchanges. OTC is coming to the exchanges. CFlex is a perfect vehicle for that. So what type of volume have you been seeing in that, and has there been a substantial uptick in that over the past few years?
Yeah, there has been a great uptick now. It's not a huge number of contracts relative to the overall volume at the exchange, but on a percentage basis, we've seen 15 to 20% increase per year over the last several years. And Dodd-Frank, as you were mentioning earlier, and the government regulation that has been so focused on some of the problems that brought around the financial crisis, in particular counterparty risk, has really, for our industry, probably been helpful, and that is to push product from OTC to central clearing and exchange trading. CFlex 2.0, again, is a product that makes not only the ability of someone who is dialing up the terms that they want to trade to submit those into the system, but also for the market-making community to be engaged in receiving those requests for quote on a real-time basis and allow that transaction to occur in the time frame that a typical electronic trade would take place. So I think between the push at the government level to get things on exchanges, our focus on the users of OTC options, and in particular the insurance industry, to come toward central cleared exchange traded contracts, and our CFlex 2.0 platform, we'll see some tremendous growth going on into the future.
You know, while we're hitting on the technology tip, it is interesting just how important tech and technology has become as essentially a core business for many of the exchanges over the past few years. And we've seen exchanges obviously spend a great deal of resources to remain competitive in the technology arena, to offer less latency, like you said, and co-location and better messaging and all the expenses that are attendant with that in terms of upgrading your systems and servers. So there's been a technology focus for a long time on the part of the exchanges from an investment perspective and a keeping up with the Joneses type of perspective. But now we're seeing a lot of exchanges moving into technology as an additional business for them. We're seeing, for example, the ISE pushing out, not just market data, but also offering cloud storage solutions, pushing out, I guess you can call them enhanced data feeds with implied vols and Greeks in the feed itself. We're seeing NYSE Arca essentially creating this NYSE Technologies division, which is another core business for them. It represents a variety of investments on their part in the technology space. So we're seeing a lot of exchanges turning to tech as transactions costs continued their race to zero and looking for additional sources of revenue. It's become a new business area for them. So I'm curious, is this something you foresee the CBOE getting more into in the coming years, perhaps branding their own technology and licensing it out and creating a technology division like NYSE Technologies or something analogous to that to actually go out there and represent the CBOE as a tech sales force?
Well, I can't make forward-looking statements as we are a public company, but in fact, we're involved in a number of areas in an attempt to capitalize on the fact that we, like other exchanges, are a technology company. So we are very much into the area of market data, historical market data. We have a separate feed for called CBOE Streaming Markets for proprietary index feeds. And we are, in fact, from time to time talking about possibly engaging in systems sales to other exchanges that are looking to upgrade their options capability. So we have our hands full. That we support multiple exchanges right now: CBOE, C2, CBSX, the CFE, and One Chicago. All exchanges that run on the CBOE Direct, soon to be renamed CBOE Command platform. So we do have our hands full with that, but we, from time to time, are requested to make proposals to other exchanges. And while up to this point we haven't made that commitment to actually engage in that business so directly as others have, we think that that's a business we'll probably be continuing to look at. As you point out, you need to diversify your revenue stream away from transaction fees, because that's an always smaller and smaller per contract revenue opportunity.
Yes, in this demutualized for-profit world of the exchanges, they all are chasing the next great idea, and it certainly seems a lot of them have cemented around the technology vendor area as a place to be. I know a lot of the large vendors in this space are certainly starting to take notice of that, as the exchanges, their traditional customers, are starting to encroach as actual competitors. So it's an interesting dynamic shift that's going on in the options market right now. And speaking of the options market, one of, and we were talking about your products earlier. If there are two products that I hear about nonstop, the Options Insider or on the radio network or whatever the case may be, it is VIX and it is Apple. Anything we do with either of those two in a headline or in the story or whatever the case may be gets a fair amount of traffic. You have something which is the Apple VIX, which combines both of those peanut butter and chocolate into one very, very interesting thing. It's a very interesting theoretical product, but a lot of people would really love to see that become a product, a tangible, tradable product. So are there any tidbits, any hints you can share with us that something like that may be coming down the road that we finally will be able to trade Apple VIX? I think given this environment, that would be an enormous home run for the CBOE.
Well, it certainly could happen. So our history in the VIX index is to bring out the VIX calculation, run that for, in the case of VIX as we know it on the S&P 500, for a few years before we bring out tradable products, starting with a futures contract and following with an options contract. As you point out, we're calculating a single stock VIX on Apple and a handful of other very notable stocks, and I think the potential does exist for us to have tradable products on that VIX index. That has been our pattern in the past, and I think that given the focus on Apple and some of the names that we are calculating the VIX on, it's certainly possible that product will come to market for sure.
Hopefully, perhaps a little bit more expedited time frame than we saw with the original VIX futures and then the options. Obviously, there was a lot more learning and market feeling out to be done with those initial products. Now that the VIX is very clearly established and a brand a lot of people know in the volatility space, and even a lot of retail obviously flock to it as well as Apple, I think there could be a much faster adoption rate for that. Speaking of VIX products, while we're on the subject, you just announced back in Boca the vol of VIX, essentially the volatility of volatility. Another one we've been receiving a lot of feedback from our users. They're very interested in it. They want to know more about it. They like the fact that unlike the SKU index, you're putting it out on a real-time basis so they can actually see it calculated throughout the day. That's much more useful for them than the once-a-day kind of download a spreadsheet type of index. And we're hearing the same inquiries about that. They want to know when this will be tradable. Vol of vol is a very important thing, particularly in VIX. And what we've seen over the past few years is this universe of ETPs exploding around the VIX contract itself. And in many ways, that universe is starting to feed back on the VIX itself and causing a lot of interesting effects, including increasing that vol of vol, playing with the term structure and causing some of that steep contango we've been seeing in the VIX futures. So there's a lot of impact that we've been seeing from this universe of products that has sprung up around VIX, and something like this, the vol of VIX, would allow people to actively trade that. I think that would be a very, very, just given from our own feedback, a very popular product. So let me put the suggestion in for that to fast track that one as well, please, sir.
We'll take that suggestion or advisement.
Speaking of one more thing on the vol side, you've announced. Well, you launched a few years ago a variance contract, similar to what you're doing with the FlexLand, where you're trying to bring some of that OTC volume onto the exchange. Obviously, variance swaps and vol swaps are a very large component of OTC vol trading, and yet for a number of different reasons, that product hasn't caught the imagination, shall we say, of the OTC variance swap crowd. You've announced some upgrades that you're planning to roll out. Can you speak to a little bit about those upgrades that you're planning and how you think those will make those contracts more attractive to that VerSwap audience?
Sure. So we have been working to try to bring a variance product to the listed options market, and we have found a very, very bright partner in DRW Investments, and to collectively, with some sharing of intellectual property, we have come up with a product, a variance futures contract, which would trade on our CFE futures exchange, which we believe will satisfy the market for a tradable variance futures contract. So while I can't go into all the nuances and details, the information on that will be forthcoming, but we think it's going to appeal to, again, the OTC market and will allow people to come to understand how variance is traded and make that a much more accessible product to the general public.
Variance is a tricky beast to wrap your head around because the notional value can be so enormous because of the strike prices, and getting that precisely right to match what they do with the OTC is a very tricky process. So I'm glad to see that you're spending more time to revamp those products and make them.
We're all about new product development, and we have tremendous resources committed at CBOE, and are proud to have a great legacy in bringing new products to the marketplace.
Speaking of new products, the new product du jour down here at the conference this year are the mini equity options contracts, primarily mini Apple, mini Google. These essentially 1/10 size contracts on large names that have become unwieldy for the average retail investor to trade. NYSE is talking about listing them. ISE has a proposal as well. I'm curious, I'm assuming CBOE is planning to get into the mini fray as well. Are you waiting for the methodology, I suppose, to be shaken out before you announce some initiatives in that? Or what is your plan on the mini front?
This is one we actually, a rare case where we're letting a couple of other exchanges do the dirty work. We think a mini contract has the potential to be successful. Certainly the weeklies have been successful. They're simply variations on the existing single stock option contract. And yes, they put two competing proposals. I think logic will prevail, and one proposal will come out and be the standard for the industry. And then ultimately, all of those products will be multiply traded. And while there's going to be a limited universe on the number of option classes in which the minis will work, we're talking about high-priced underlying securities. We think that that'll be a real potential successful product, and we'll just hope we get it out before Apple splits.
Yes, exactly. You want to strike while the iron is hot, and while everyone and their proverbial mother has Apple in their account in some way, shape, or form. And it makes sense to have that approach too, where you don't want to have 9 or 10 competing standards for mini options that would just fragment the liquidity and lead to much more confusion on the retail front. I think before we wrap up, there's one other thing I wanted to get your opinion on. It dovetails into that retail and Apple audience to a great degree. I'm not sure if you were at the FIA Exchange Leaders panel last month, but towards the end of it, our pal Tony over at Box made what was kind of a throwaway comment at the end, but it was very interesting to me because it's something I've been mulling over in my head for quite a while too. He mentioned that a lot of retail are frustrated in this day and age for, let's say they're trading a name like Apple. They have upside calls in Apple or whatever the case may be. Earnings come out and the stock takes off in the after hours, and the predominance of that move occurs in the after hours. And so for the vast majority of retail customers who don't have the account size or perhaps the savvy to hedge with the underlying like a market maker would, they're limited in what they can do in that scenario. So they're forced to wait until the open, and quite frankly, frequently the move has already happened and perhaps retraced a bit to the other side. The volatility has come in, and quite often it's a losing trade for them. So it's a very frustrating scenario for them to have to watch these events unfold and not be able to participate. And what Tony had suggested was perhaps some sort of after-hours order book, or however it want to be implemented, to facilitate some of that. Maybe people wanting to close out positions or get out of an open call position, or whatever the case may be, and try to capture some of that after-hours dynamic with options. And so I've been taking the pulse of the various exchanges and brokerage firms down here, and I will put it to you as well. Is the CBOE interested in pursuing something like that or supporting an initiative like that will allow retail to have more access to these types of moves?
Well, I think if you can ensure that there is some degree of liquidity that would be available so a retail order could get a reasonable execution. As you know, as a market maker, former market maker, the ability to provide markets in the absence of a viable underlying security market is very difficult. Yes. But to the extent that we could be convinced that there would be sufficient liquidity provider involvement and commitment to participating in an extended hours trading session, I think that's something we could look at. We are definitely looking to extend our trading hours as to the VIX itself. We did extend our hours in the morning, and I think there's certainly some interest in seeing our hours for that particular product even earlier and possibly a little bit later in the day. But as to single stocks, a little more difficult. The option product, as you know, is a very fragmented product with so many series, 300,000-400,000 individual securities trading on a regular basis.
Where do you put that demarcation? Is it just front month at the money? Where do you break that out? Yes.
Yeah, so it's tough. But again, I think the equities world is a little bit more order driven. In the options market, you really need market makers to provide liquidity because there's so much fragmentation across the product.
Yes, and you're right. And it would be difficult with the underlying swinging 10, 20 handles at a time to have someone provide a steady market. So maybe you could start with something, just matching orders and then let people close out positions where they want, and then perhaps you could facilitate from there rather than having to have some firm stand in there and be 50 or a couple hundred up when everything is moving quite dramatically around them. Well, Ed, I'm glad we could finally bring you on the show. I'm glad you finally stopped dodging us here at the Options Insider Radio Network and agreed to sit down with us. But I'm glad we could bring you on. And is there anything else you would like to address before we wrap up here?
Well, listen, it's a pleasure to be here. I am a big believer in that the options product. It has tremendous growth in front of it. Every time I go out and meet, especially with institutions, pension plans, and the like, there is a tremendous still non-use of the product in places where it definitely should be used. Pension consultants, portfolio managers, hedge funds, those who understand how the product can properly be used are doing so, and those people who don't understand the product, it's still believe that it is not risk reducing, it's risk additive, and I think they're wrong on that. And it's our job as an industry, and certainly your program will help accomplish that, is to educate people about the proper use of the option product.
We try. That is our mantra here. And, of course, we had a discussion similar to that this morning on our panel here at the Options Industry Conference about advisors and their use or lack thereof of options. So there is a lot of interesting top discussion there, and I encourage our listeners to go and download that panel session on theoptionsinsider.com so they could hear more of that. But, Ed, thank you again for coming on the program. We'll have to do it more frequently than perhaps once a year at OIC. So we'll look forward to having you on again down the road. Perhaps towards the end of the year we can talk perhaps more about some of the CBOE command upgrades, some of the updates to the variance, some of the other products we discussed, and have a little more insight into some of those upgrades and updates we were talking about.
It's great to be with you.
Great. Thank you.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.